Welcome to the FinTech One-on-One podcast. This is Peter Renton, co-founder of FinTech Nexus and now the CEO of the FinTech consulting company Renton & Co. I've been doing this show since 2013, which makes this the longest running one-on-one interview show in all of FinTech. Thank you so much for joining me on this journey. Now let's get on with the show. Today on the show, I am delighted to welcome Ryan Rosett. He is the co-founder and co-CEO of Credibly. Now, Credibly is a small business lender, really interesting company, been doing this a long time, since 2010. And they call themselves a data science-driven lender. We actually get into what that really means. And Ryan also shares some really fascinating examples of generative AI and how they're using it in their company today, something I had never heard of before. We obviously talk about the challenge for small business and how FinTech has been addressing that challenge. We talk about their business banking offering. We talk about the banking as a service debacle that we're going through right now, and much more. It was a fascinating discussion. Hope you enjoy the show. Welcome to the podcast, Ryan.
Thanks, Peter. Glad to be here.
Okay, so glad to have you. Let's kick it off by giving the listeners a little bit of background about yourself. I know you've been at Credibly for some time, but why don't you hit on just give us the highlights of your career to date.
So just to give you a little bit of background, so I started the business in 2010 with my partner, Eden King. We originally started it, we had a joint venture with a smaller factoring bank. And the reason I say that is it was sort of interesting just because at the time in 2010, the business was sort of the Wild West. And we had to sort of grow up much quicker and become compliant because we had the FDIC in our office once a quarter. So really that was so the culture of compliance from a FinTech standpoint was in place, intact, really early in our business venture. And I would say we were probably one of the first, if not the first, to actually have a joint venture with a bank. When you think about the time, it's 14 years ago.
Right.
Fast forward, we took on a private equity partner in 2014. We did our first securitization in 2018. We just completed our third securitization about 2 months ago. And we continue to grow and innovate and evolve as this business continues to, mature as alternative lenders are becoming a little bit more mainstream.
Well, let's go back to 2010 or before 2010. What was it that you saw? What was sort of the reason and the story for founding Credibly?
Both my partner and I are lawyers by education. I never practiced. My partner did. I was in real estate development for 15 years and then got into short-term bridge loans sort of during the Great Recession, when there was opportunity where banks were sort of purging assets and borrowers with income-producing properties needed money to buy them back from a bank at a discount. So we were doing short-term $2 to $5 million loans, kind of mid-teens type yield. And it led me to this business, small business lending, which was at a contrarian time because it was almost like this whole conversation about a double-dip recession and things of that nature were out there. But the access to credit wasn't. So small business just could not obtain capital. And so we thought this was an interesting time to start a business because there was such a need for capital as businesses needed to grow. Mm-hmm. So really it came from a pretty, genuine place of trying to help small businesses secure capital. And we always were a non-balance sheet lender. So we never started the business as a broker and converted to an on-balance sheet. We started as on-balance sheet and tried to, for better or worse, figure it out as we went along and learn.
And so did you put that bank partnership in place from day one, or when did that bank partnership start?
Yeah, so it was about 9 months after we started. So wow. we started and we had we had our own money in the business. We raised a few funds to finance the business. And I recall very, clearly we had this small office in downtown Birmingham, Michigan. And I remember having this bank come to our office, and we had signs. We almost had to, like, we were too young of a company to forge a relationship like this, but they really liked the idea and the concept and us. And it took a long time to negotiate, but we were successful in negotiating this joint venture, and it proved to be like a really interesting funding source for us to grow the business, and it was a really profitable venture for the bank as well.
Right, right. Because I imagine, the bank probably wasn't able to, a lot of banks pulled back from small business lending, right? Particularly during the financial crisis. So how long did that bank relationship last, or is it still in place today?
It lasted through 2014. Really, what happened is we were a single credit for them. So we created an SPV as a
Okay.
joint venture between the two, and we became like too large of a concentration risk for them.
Right.
They were like a $500 million bank.
Okay.
I think at the time, I think we grew it to about $25 million, and they were just said, listen, the returns they were getting, they were taking like a 12 or 13% return on average assets, which a typical bank I think makes 1 or 2% return on
Right.
average assets. So they were like, it was like a very healthy return for them. They actually really liked the relationship. They said, hey, you have 1 year, go find senior credit facility, take us out. We love your relationship. We'll be an advocate for you, but this is something that we need to do for the business.
Okay. And so you replace them with obviously other funding sources.
Correct.
Okay. Okay. Well, let's maybe talk about, you were very early on. I mean, obviously before fintech was a thing. I mean, there were others out there like, On Deck and Cabbage they slightly predated you, but fintech lending wasn't a thing. But from, doing this, for 14 years and how you operated back then versus how you're operating today, tell us some of the sort of the evolutions that your company has undergone as the industry has kind of changed dramatically in the last 14 years.
I mean, like, let me say that, the evolution has been, if I can go back to like when we originally started, we really were only doing split processing. So, it was started out as a merchant cash advance company. We were the first company to partner with First Data at the time. It was First Data before it was Fiserv. And we were doing split fundings. And so we were really kind of targeting the First Data customers. I remember very clearly, looking at my partner and saying, like, why does everyone collect bank statements? I didn't understand, we didn't understand that. So, and, what sounds sort of elementary, for what we were doing at the time, it was like an interesting time in the business because we were learning as we went.
Right.
And now when you look at the landscape of like how advanced we've become and how much automation we have in place to handle the flow that we see, it's really, everything in the beginning was obviously like underwritten by hand. There was, it was all like keyed in, all the, once we understood how bank statements played a role, those were, all spread into our own, kind of makeshift Excel spreadsheet, which is the way we started until we evolved to create our own loan origination system because there was no off-the-shelf loan origination system that worked for our business, to then moving to like our next generation loan origination system that we created and are still on and continue to invest heavily into. So just the technology automation that where we started to where we are today has, we're two completely different businesses from a scale perspective, from, I would say sophistication and staffing to how our applications actually work, how the automation works. And then, I'm sure we'll touch on generative AI, but like even, today, where we're starting to use, real scenarios around generative AI that are extremely helpful. And we have a number of other kind of initiatives that we're working on that I think are going to just continue to help us make for a better customer experience when they interface with us.
Right. I do want to talk about generative AI, but I'm going to leave that to later in the conversation. Maybe you could just talk about what you offer today. Do you still do MCA? I mean, what's sort of the suite of products that you're offering?
We do, 40% of our business is MCAs, 60% is loans. We do business in all 50 states. just depending on the states that where we offer MCA versus loans, but that there too, it's all automated within our system. So whatever product that we have available, we offer to the customer if it's available in the state. Again, each state has their own sort of guidelines, as I'm sure you're well aware of. And so staying very current from a compliance standpoint is key to this business, because it's something that you can't fall behind. And if you really want to stay in the as a top alternative lender, which we believe we are, those are the things that you need to do in order to just continue to compete.
So then I want to sort of step back for a second, because, I feel like I've been having this similar conversation really since I started doing the podcast 11 years ago with a lot of different small business lenders. And there's a lack of access to capital for small business. That is a given. We know that that happens, but that was true in 2014, and it's still true in 2024, it seems. And fintech has really, I think, attacked the problem fairly aggressively, and I think we've done a fairly good job. But I'd love to get your perspective of how much progress you think has actually been made for the typical small business owner who is still struggling with access to capital.
So progress, here's the reality, and why I think this business exists, in my opinion, is that our average loan size kind of hovers around $70,000.
Mm-hmm.
If you think about it from a bank perspective, banks aren't equipped to lend $70,000 to a small business. So while they can and will, the economics associated with it versus the risk of actually lending $70,000, I would say just the risk outweighs the benefit. So in scale, I think, when you look at the businesses across and why alternative lenders exist, I just don't think banks choose to sort of compete in this environment right now. Nor do I believe they're equipped to. And when you think about also the sort of macroeconomic headwinds that come that, in various stages over a decade, banks tend to pull back, and then they'll go a little bit too long in a certain lending, and then they pull back. And then the pullbacks are usually like longer periods of time where we can adapt in hours, where if there's a forest fire or a natural disaster, we have the ability to really just kind of adapt in real time, where like if we need to do a site inspection or whatever the case may be, if it's in some area that's been affected, those are things that we can do very quickly. And I just don't believe banks today are equipped, nor do they have, I would say, the interest to like sort of enter into this. I would say it's a tricky lending space, because like you are underwriting an entity. Yes, you're underwriting a small business owner, but at the end of the day, it's shielded by an entity. And really what we're lending against is cash flow. So and that has like been part of our evolution as well. So we are, I would say 100% cash flow lenders. So we're looking at average daily balances. We're looking at negative days in the bank, how many NSFs, and then we lay in some credit profile as well of the small business owner to ensure like how we can risk-based price a specific merchant. So like that's, and if you're a high quality merchant that's been in business for 15 years and you have good credit, you're going to get great pricing from us. And if you're a 6-month business that has spotty credit, we're going to price that accordingly as well to accept the risk that we may take on.
So then would you say that, in this particularly, I'm talking about the sub 250K segment as far as loan size goes, is it fair to say that small business owners are better served today than ever before?
I think their options they do have options. I mean, there's no doubt that we are more expensive than a bank. We borrow money from, we have asset-backed securitizations. We have senior credit facilities from banks. So like, no doubt, like if they can access a bank, anyone who asks me, they should. However, if you need your money tomorrow, we are a great resource for that. Or you need your money in 2 days, or whatever the case may be, I think we're an excellent resource for that. So I do believe that small businesses have the ability to access credit much easier today than, say, a decade ago.
So just take us through the underwriting process. I mean, how much of it is automated? How much of it? How long does it take between application and approval?
So depending on so we have like a few different channels. So we have
Right.
we have a direct sales channel. We have people who find us online. They can go through an online experience, which has full automation. So if it's coming through a wholesale channel, typically from application to decision. So if it's a decline, it can be seconds. So I mean, we have a bunch of a bunch of models running, and if it's declined, it happens almost automatically. If there's an approval, usually like 2.5 to 3 hours, like we have from app to offer. And then depending on if there's any conditions to fund, which sometimes it might be just like driver's license, voided check, it can fund, in an hour after. So, and if they're eligible for, what we call an online checkout, that's a 10-minute process and their funds are deposited into their bank account. So it's like there's a few different ways. It just depends on how complex or hairy the deal is, that from an underwriting perspective is there multiple owners, is there any issues that pop up in the underwrite that potentially cause further questions that need to be identified. Those are where it takes a little longer, or we may require additional documentation that an underwriter needs to review. But we are, from a, I would say, a happy path deal where it's like clean and there's really no unanswered questions. You can be funded, I mean, it could be a 10-minute process.
You've called yourself a data science driven lender. So maybe you could sort of give us a little bit of color there. Like, how are you using data science in your underwriting?
So we use data on everything we do. So it's, we're using data from really like the origination perspective, like from marketing, all the way through portfolio management, funding, and certainly, on the collection side. So like there's, and then when you look at obviously our scoring models and how we pull different levers that we need. If, for example, if we see, certain industries that are underperforming, we may pull back, where the term may be shortened, maybe the rate may increase a touch to cover any potential losses that we can, so that we can make up. Those are examples where, the data that we're looking at is very vast, and now we have several $billion of like collection data, so we know what's happening on industry type seasonality, and we're able to price for it better.
Mm-hmm.
So I think with the data that we have, it allows us to be more aggressive where we want to be more aggressive, and more conservative where we need to be more conservative. So, and it's never ending. So it's like it's a constant change, because like industries change. Like, for example, trucking was like amazing during the pandemic.
Right.
Okay. And then until it wasn't. So it was, and like, in plenty of companies got caught, stuck with a lot of trucking in their portfolio. We were fortunate that we did have trucking in our portfolio, and it took a while to, kind of get it out. But like that's an example where an industry kind of flipped upside down. And you could say the same about like construction, with mortgage rates where they are. There's a little bit of all there's some like macro trends that we look at, and then certainly we look at data that happens within the portfolio to make better decisioning.
Okay, so then let's segue from there to generative AI. I read that you recently applied for a patent around Gen AI powered underwriting. Now, I'm curious about that because, I mean, obviously, AI has been used in underwriting in fintech lending for a decade or more. And I haven't seen much in the way of generative AI. And when you talk to some of the other fintech lenders, they don't really talk much about it. So maybe explain what the patent is and what you're doing exactly.
We have a few patents that are pending. One specifically I'll kind of get into is, if you look at, like, for example, the Nixis code, or so like Nixis NAIS code,
Yep.
or CICA, versus the SIC code, which is like basically an industry classifications, and there's over a couple thousand industry classifications. And so what we've done is we'd have an underwriter select the industry type. Okay. And like, if I I use an example just, as like if it's, Peter's Electrical LLC. Okay. Are you an electrician? Are you an electrical supplier? Do you manufacture electric, switches? Don't know. And so it relies on, we're historically relying on the underwriter to put in whatever code they determine. What we've done with our provisional patent that's pending right now is it allows us to really go through a workflow leveraging large language models and identifying through a waterfall what is the best Nixus code by prompting questions and for this specific business. And we found a 25% lift of accuracy over humans on the selection of the correct industry by using this generative AI tool. So it was that's just like like an example, but it's like not only does it save us time, we get more accurate. And then when we're more accurate, it removes some of the subjectivity and it makes it more objective where we can be, I would say, better at calling risk on certain businesses that we otherwise were making mistakes on because we didn't know if you were an electrician or a supplier. And there's a huge difference between that in terms of like how we underwrite files.
Right. That's really interesting. So then the data that's being generated, or the data that the large language model is using, is that like who's answering those questions? You said that there's certain questions that go up. Is that the borrower that is answering those questions, or how does that work?
No, the way that we're creating this workflow is it goes through a pattern of questions and then it comes up with a ranking and then it re-ranks it and then re-ranks it so that we get the best answer that comes out of the Gen AI. So, or
Okay.
the large language models we're using. So it has nothing to do with the customer whatsoever. We're not looking for them to supply us any information.
Okay.
We are looking to identify the accuracy of the industry code.
So you're using external data sources for that then, right?
Yes.
I mean, I'd love to just get a little bit more color because this is completely new to me, and I think it's a fascinating thing. I think the audience will find it interesting. I mean, I presume you're just going out there and you're doing this in a way that it's a closed system, right? You're not sort of going out and waiting for response and so on. I mean, maybe you could talk a little bit about the data that's being fed into this.
This is an example of like, we have a lot of information about a business. Okay, so we may know, for example, credibly, it's like we are located in Southfield, Michigan at this address. What do we do? So some companies might say we're financial services, some may say we're a fintech, some may say we're a data-driven something, but where do we fit into the couple thousand codes? And so that is so once we have a bunch of information about our customer that gets fed in as the same way if you're looking for like an example, a restaurant review using Google, you'll put in XYZ restaurant in Detroit, Michigan, and it will then come up with that restaurant. And then you can look at the reviews or what it looks like inside or whatever the case may be. This is like, we're doing a very similar, like our own way of identifying the customer to get more accuracy around what exactly they do without using humans. So, which is like which even though let's just say this process took us like 12 minutes to do on average for a typical underwriter, but when you take 12 minutes across thousands of applications, it's meaningful from a time
Right.
perspective. It creates a better customer experience, and we get a more accurate answer, which is more important to us because if we get a more accurate answer, we can have what we deem to be like the better probability of default and more profitable business coming through our business.
Would you price loans differently given the different industry classification because some industries are just more risky than others?
Of course, 100%.
That's where the advantage lies, right? You now know with better accuracy. Obviously, it's probably not going to be 100%, but you're doing a lot better than before, and so now You have much more confidence that the industry that you're getting is correct.
That's exactly right. And I said it before, but it creates like a more objective, determinative answer that we can have more confidence in than before. Like when I
Right.
say even like, and our 25% lift is getting better as it's continuing to improve. I mean, it still has like machine learning pieces to it. So it's getting more and more accurate, which creates more accuracy around our ability to call risk.
Any other Gen AI initiatives you're willing to share at this time?
We have a few on the bank parsing side, and we also have, we have a few on the marketing that we're working on as well. But at this time, I mean, that's the one that's like it's been installed. We've been leveraging it for maybe 3 months now, and again, it's like this generative AI is like it's new, so we're learning. I am certainly not a generative AI expert, but like I find it fascinating. And I think that there's just a world of opportunity that we are exploring leveraging in our business. And I think we're a really good business to use it.
Okay, so I want to talk about banking and specifically business banking, because that's something that I saw you launched last year. What was the thinking behind that? And can you tell us about the traction that you're getting there?
So we see any given day, it could be 1,500, 2,000 applications a day. And about a third of them don't have business banking accounts.
Wow.
And so and we don't lend to a small business that doesn't have a commercial bank account.
Mm-hmm.
So we'll lend to partners, we'll lend to sole props, but they have to have a business banking account. So otherwise, it would be deemed a consumer loan, and then you have the CFPB, and
Right.
you have all the other
Loan,
criteria that you have to follow. Yeah. So we're a small business lender. What we've done now is those 1/3 of applications that come through that get rejected, while no one likes getting rejected, at least we can give them an option to sign up for a business banking account. We have a partnership with Green Dot. It's a white label solution for us. It looks like we're not a bank, but we do get visibility into the bank accounts that are signed up. We have the traction has been growing, and the take rate has been, I would say, what we expected. So it's a growing number. It's not something like we do have a shared interchange fee. We don't view it as a huge profit center for us, but like if we can bring a customer in, nurture that customer, track their volume, and then proactively push an offer out to them that you've been pre-approved for, that's the sort of interesting part of like the relationship that we have on the business banking side.
Right. That's interesting. And I should clarify, we're recording this on June 28th, and the banking as a service space is under duress, shall we say. It is there's been some major challenges with some of the leading banks that have been doing this for a long time. You're using banking as a service for your business banking. Well, you've obviously been following this. Everyone, it's been like this dumpster fire that has been slow moving over the last several weeks. But do you have concerns, or what's your thoughts on the impact of relationships like the one you have with what's been going on?
So I don't think there's a huge, I think banking as a service for companies that they have partners with banks and they're offering banking services to others, white label, but they're not a bank themselves.
Mm-hmm.
I think those businesses are problematic. When you look at banks that are white labeling services that they already offer, and Green Dot, for example, I mean, they do the banking for Walmart. You mentioned Intuit, among many other sort of large players that they're sort of the bank behind the curtain. And so I'm not as concerned about their business model as some of the other sort of neo banks that kind of pop up and don't necessarily have, I'll say, the balance sheet or support or the insurance that everybody's looking at. So, like, for example, like that is why we use Green Dot, and I'm not opposed to saying Green Dot, even though it's a white label solution. at the end of the day, we're not a bank.
Right.
And so if a small business opens a checking account, I want them to know that the checking account's with a real lending institution that's, has a balance sheet and it's publicly traded, and the FDIC insures them, their deposits, so I don't, and I put myself in the shoes of a small business owner. I too would want that.
Right.
So, that's the way I sort of look at it. I don't, we've never found it to be overly interesting to like be like, there's concepts out there, lending as a service. That's not what we think is a very interesting business model. And like banking as a service is also, depending on the business itself, wasn't overly attractive to us. And I know that there's been a lot of turmoil. I think it can work on some level. And I think, Green Dot's an example where I think they do make it work.
Okay. So can you give us a sense of the scale you guys are at today? Can you give us any kind of metrics there?
Yeah, like so, this year, like we'll, again, we fund, our average loan size is, kind of hovers at 70,000. This year we should do between 450 and $500 million of origination. This year we, by design, kind of slowed our growth a little, just because and when I say that, we kind of cut off the lower tiers of we have 4 different bands. We have an A, B, C, and D band. We cut the C and D band off about 9 months ago.
Wow.
And that was, I don't know, 25, 30% of our business. We have picked it up in Bs and Cs, but in the same token, we saw performance issues with the Cs and the Ds. And we started now offering, we have brought back the C band, but there was a period of time where small businesses, and I still would say, I don't know if they're still in a recession or not, but, clearly I think small businesses were in a recession, even though the general economy wasn't. I think small businesses were experiencing a lot because, you look at inflation and things of that nature, it was affecting small businesses and their profitability.
Okay, so last question then. What's next for Credibly? What are you looking forward to for the last half of the year and into 2025?
Yeah, so we just we continue to innovate around our technology. Like I mentioned, this online checkout is something that's new for us. We just came out of beta, and the reception has been really strong. We think it's sort of best in class. Just we're the newest to do it, so like we had the benefit of like seeing what others have done, what worked well, what hasn't, and tried to take the best from everyone and kind of build our own that really works well and protects us from a risk standpoint. We talked about generative AI. I think, if we can continue to scale the business and not add more heads, I think that would be a huge win for us, and also allow us to manage our risk better. So we sort of have a philosophy, like we're not trying to do a million things. We want to just be really good at what we do. And we think we are pretty good at it. So, it's not as if we're trying to offer all different types of products like banking as a service or this or that. Like we want to be very good working capital lenders. And I think we're doing a good job at that.
Right. Well, it's a good note to end it on. Ryan, it's always great to chat with you. Thank you so much for coming on the show today.
Thank you, Peter. I really appreciate it.
Well, I hope you enjoyed the show. Thank you so much for listening. Please go ahead and give the show a review on the podcast platform of your choice and go tell your friends and colleagues about it. Anyway, on that note, I will sign off. I very much appreciate you listening, and I'll catch you next time. Bye.